Transfer pricing as a concept had its evolution as international trade grew up by leaps and bounds. I would say after the First World War, that is 1920. It further gained momentum after the Second World War, that is 1945. And as transfer pricing arises because of a multinational company operating in various jurisdictions, and those jurisdictions having different rate of tax. Some countries having higher rate of tax and some countries having a lower rate of tax. The multinational group as a whole at the group level would like to minimize the taxation incidence on its global profits. I can explain this by a simple example. Let us say we have a multinational company headquartered in USA, and it has got a subsidiary company in India. Now, subsidiary company, let us assume a simple example that it sells certain basic goods which are purchased by the Indian subsidiary from the parent, let us say at a cost price of 100 per unit, and they are sold to the independent customers in India at, say, per unit rupees 150. So the gross profit on this per unit sale is rupees 50. At the moment, I am not going into the details of further expenses of the Indian unit, just to explain the concept in a simple manner. Assuming this 50 is the profit, net profit of the Indian company, India tax rate at the moment is effectively around 34% on company. So around 17 rupees, one third of it will be the tax, and 33 will be the post-tax profit by the Indian subsidiary. Now, this tax of 17 rupees which is generated and payable in India can be sought to be reduced by interposing another subsidiary in a low or no tax jurisdiction, which also I will explain by example. So let us see earlier example. We said that the American parent is directly selling goods to the Indian subsidiary, and in that example 17 rupees was the tax which was payable in India. Now the same multinational is interposing, let us say, a company between India and USA, and that company is in British Virgin Islands, which is a no tax country. So what this company can do, sale price of the goods from US company to a subsidiary, we had taken 100 in the earlier example. So that 100 remains the sale price from the US company to the BVI company. And let us say BVI company then makes an invoice selling the goods, same goods, to the Indian company at, say, 130. So in that situation, the sale price to US company being 100 remaining fixed, 30 rupees of profit is generated in British Virgin Islands, and Indian company purchases goods at 130 and sells at 150, because sale price can never change in this situation because that is a third party sale price. So the profit which was 50 in earlier example has been divided between India and BVI. 20 is the profit in India, 30 is the profit in BVI. This 20 suffers tax at 7 rupees, almost one third, and no tax in BVI. So the US multinational parent having the same income of 50 arising to it offshore has suffered tax in this second example at 7, in the first example at 17. So this is the conceptual basis of transfer pricing. because the subsidiaries and joint ventures of a multinational group, they operate in various jurisdictions and all of them are controlled in terms of equity ownership or in terms of management rights, like rights to appoint the board of directors or right to remove the board of directors. Because of these factors, they can manipulate the prices of the transactions being undertaken between their various intra-group entities and therefore manipulate the tax payable in various jurisdictions, typically minimizing the tax payable in high tax jurisdictions and typically maximizing the profits in low or no tax jurisdictions.